Hello, and welcome to my YouTube channel, Texas Mortgage. If this is your first time, welcome. If you're returning, glad to have you back. This segment, we're going to talk about interest rates and all the pros and cons of interest rates, from loan terms to write-offs to benefits, buy-ups, buy-downs, you name it. We're going to cover it right here in a short video that's going to benefit your next purchase. Okay, one quick note. I'm using my portable microphone, the Rode portable microphone, because I'm not in my home office. So with that being said, talking about interest rates, there's a couple things to note right away between a low interest rate and a high interest rate. If you have a high interest rate and you owner-occupy your home, in other words, it's not a rental property, you can deduct all the interest on your taxes as an owner-occupied house. Also, if it's your first year, you can deduct origination points if you purchased the house and paid origination points for your loan. Those are two things you can deduct. If your interest rate is lower, your tax deduction is going to be lower. So that's two quick things about the interest rates, high and low, to think about. Okay, when it comes to pricing your loan, the lender's going to talk to you about different price options for different price points of the interest rate, because it's just like a commodity. The prices change every single day. So what you're guaranteed today, you're not guaranteed tomorrow. Prices go by buying them up or buying them down. For example, let's say that a par price was 7%. Par means that it costs you one origination point from the lender to get a 7% rate. If you tell the lender, hey, look, I can't afford that payment, I need to lower my interest rate, what do I need to do? The lender's going to give you some options to buy that rate down. So for example, if you want 6.5%, 6.75%, 6 7/8, it just depends on what the pricing is for that day for that loan. The more you buy down that interest rate, the more it's going to cost you. Conversely, if you want a higher payment and low cost or less cost or even a credit from the lender, you can ask for a higher interest rate and you will get credit back. And again, it's exponentially higher the more you go either way from that par price loan. Okay, when you're talking about all these price points, what that means is it's a percentage of the loan amount. So if we say par pricing at 7%, and that's going to cost you one origination point is 1% of the loan amount. If you borrow $300,000, 1% is $3,000. So when you're looking at the pricing, it's going to be based off that origination point, up or down, whether you're going on the high end or on the low end. High interest rate, low interest rate. Just depends on how they price it, and that's what the money correlates to in terms of out of pocket or credit to you. Okay, I want to talk to you about a 30-year mortgage and the pros and cons. The pros are they're affordable. That's why people use them, because they're very affordable. They're amortized over a 30-year period. The downside, they're very expensive. In terms of payment-wise, your first 15 to 18 years are covering the interest only, just about, a little bit of principal and a large portion of interest. The tail end of that loan, about the last 15 years or so or less, are covering the majority of the principal. So if you just kept a 30-year mortgage, you'd be paying almost twice as much for your house after that 30-year period is over with. Not very attractive. Back in the 80s, when people bought houses, they had to put 20% down. What that did was keep the prices of home lower so people could afford it. Today, with all the fancy products on the market, it's caused or helped increase the price of housing. That's one thing to look at on a 30-year mortgage that's not very attractive. Okay, now that you've learned the hidden secret of a 30-year mortgage and how they're not that great, we'll talk about two other concepts. One of them is a 15-year mortgage, and the other one is doing bi-monthly payments or prepayments on your 30-year mortgage. If you get a 15-year mortgage, you're going to pay a higher initial interest rate, which means a higher payment, and you're also going to be paying that loan off a lot sooner and paying a lot less interest over that 15-year period versus a 30-year. If you have a 30-year loan, you could make extra payments to pay that principal down and have the payments go right to principal. A lot of banks set you up for that. So there are a couple ways to avoid paying tons of interest and still pay for the house for a reasonable price. Okay, hopefully you've learned a couple good tools to think about when it comes time to pricing your loan and whether you pick a 15-year or 30-year mortgage. There are other products available, and I'm going to have more videos on those, like ARM loans, government loans, and some other things. But for right now, this is enough information to make a decision about a 30-year mortgage, a 15-year mortgage, what type of interest rate you want to buy up or down or at par priced, or if you want to do prepayments on a 30-year mortgage and make it affordable and just pay extra when you have the extra money. Hopefully this helps. Look forward to seeing you soon. Thank you. Again, I want to thank you for tuning in to Texas Mortgage. My name is Michael Green with Synergy One Lending, and hopefully we've given you some information to help you. If you have any questions anytime, please give me a call or email. My information is located on the YouTube channel. Make it a great day, and we look forward to seeing you soon. Take care.